Welcome back to Your Average Investor, the channel that looks at my journey through investing, budgeting and finance. Now, for those of you who've watched my channel for a while, you'll know that I hold most of my investments in ETFs on the Vanguard platform. However, I also hold smaller portfolios in cryptocurrency on eToro and in individual stocks and shares on Trading 212. Now, it's been quite a while since we last checked in on my Trading 212 portfolio, and there's been lots and lots going on in the market. I've also made some additions and removed some companies from my portfolio for a variety of different reasons. So today we're going to hop back into Trading 212 and we're going to have a look at my portfolio. We're also going to have a look at Trading 212's new online accessible app rather than the mobile app, and we're going to also have a look at how my portfolio has changed and where I see this going in the future. Let's hop straight in then and check it out. Here we are then inside my Trading 212 portfolio. You can see that the current value of my portfolio is £3,449.06, and that's up around £650 since my previous portfolio update. This means that my portfolio is currently up £440.41, which equates to a return on investment of 14.64%. You can see that I currently invest in 17 different companies, and that's down from around 20 or 21 in a previous video. So we're going to hop straight in and have a look at exactly what I'm investing in and exactly how the portfolio has changed ever so slightly since previous. Something you will notice is I've sold out of my AstraZeneca position and I've actually moved that across now into Pfizer. Now, both of these companies are excellent dividend paying companies, and it's been a really interesting time for them both throughout the COVID pandemic. I'll talk a little bit more later about why I've moved across to Pfizer and the long-term growth that I see in Pfizer that I didn't necessarily see within AstraZeneca. The first company in my portfolio is Alphabet, with a current allocation of £232.95. Now, this investment is up £46.48, or around 25%. This 25% that I've made is really impressive, especially considering I didn't invest in at the cheapest point within the last few months. You can see by the dotted line that I invested just here, just before this latest peak within Alphabet's share price. However, this previous year has been really strong for Alphabet, with it up around 83% year to date. I currently own 0.12 shares in Alphabet, and whilst it doesn't yet pay a dividend, I'm going to continue to invest into this position. Alphabet is a massive company central to the technological space, so I can see this company continuing to grow for the foreseeable future. The second company is Amazon, and Amazon have had a particularly interesting 18 to 24 months, and we all know why that's been. You can see here this massive spike throughout 2020 when everybody was at home and everybody was online shopping. However, if we flick across the 1 month graph, you can see this cliff here, which Amazon pretty much fell off earlier last week. And this was because of their earnings reports and their sales reports, which have come out recently. Now, this isn't to say that Amazon is disappearing by any stretch of the imagination. This is just people in the markets being fearful that Amazon won't grow as much as expected in the next quarter or few quarters. For me personally, I see this as an excellent buying opportunity. This could potentially be the cheapest we see Amazon for a long time. And these opportunities do not come around very often. So I have actually bought back in again to Amazon, not a massive amount, but I'm going to continue to pound cost average into them. I currently own 0.1 shares in Amazon, and this is valued at £241.01. £12.16 of this is in capital growth, and that equates to around a 5.31% return on investment. The next company we've got then is Apple, as you can see here. I currently hold 3 shares in Apple, which are valued at £316.72. I've made £40.68 in capital growth, which equates to around 15% throughout that time. And you can see over the last year again, Apple have had a particularly strong time going from strength to strength. The next company in my portfolio is AT&T. Now, AT&T are the only company within all of my portfolio which are currently underperforming and seeing a negative rate of return. My investment is currently worth £160.02, and that is for 8 shares in AT&T. I'm currently seeing a loss of £18.24, or I'm down around 10% at the moment in that position. The next company is BAE Systems. Now, I initially got this company as a free share. However, due to the dividend income, which is around 4.44% per annum, I saw this as a company that I should be investing in for a nice income into my portfolio. It also makes my portfolio more rounded. This is obviously an aerospace and defence company, which I didn't actually have much exposure to besides Boeing within my portfolio. So BAE Systems, I've currently got 32 shares in this company, which are valued at around £185. I'm currently £32.87 up, which equates to around 21.5%. The company directly below them is Boeing, of course. I've been invested in Boeing for a long period of time now. Unfortunately, again, they did cut their dividend, which means I'm not getting any dividend income from them at the moment. I'm currently up £36 or 23.24%, and I am considering at the moment selling out of Boeing and moving this almost £200 into different dividend paying investments. The last 2 years have been a really tough time for aerospace, for travel, or any company which is to do with going on holiday and moving people around in large quantities. If we look at their graph, we can see a definite plummet here when everything got shut down and everything got locked down. The share price dropped by over 50%, and I was quite fortunate to buy in towards the bottom of this crash. So I've been able to reap the rewards of things opening back up again, planes flying, people going back on holiday, and seeing a really nice rate of growth from my initial investment. The share price is still down around 25 to 30% from its initial pre-lockdown highs, so there is definitely still room for growth within Boeing. I'm going to have a little think about whether I want to continue on this path for now to reap the rewards of the potential growth that we'll see, or whether I want to sell out of this position and move it into a different dividend paying company. We've then got Coca-Cola, which pay a 3.09% dividend. I've currently got 3.66 shares in Coca-Cola valued at £147.68. I'm currently up around 6.5 to 7% in Coca-Cola. Again, we can see the really nice growth that we've seen from Coca-Cola since things have opened back up again, and it's now almost back up to its pre-lockdown highs on February or January 2020. We then move on to the only ETF in my portfolio, which is of course the iShares Global Clean Energy. It's been a fairly volatile time for this ETF, with it reaching heights of around £14 per share, with it now trading at around £9.50 per share. I hold 15.7 units of this fund, and I'm currently up £7.40, or around 5%. I see this investment as a great hedge against some of my other investments in my portfolio, particularly that of Royal Dutch Shell. We know that global clean energy will be here in the next 50 years, but perhaps oil will be phasing out. And if Royal Dutch Shell don't pick up their game and don't move into the clean energy market, then we could see a massive reduction in their share price. Therefore, this investment in this ETF I see as a hedge against that potential loss from Shell. Then there's Johnson & Johnson, which pays a 2.6% dividend. I've currently got 1.24 shares in Johnson & Johnson valued at £155. I've also received dividends throughout this time from Johnson & Johnson, which we'll have a look at in a moment. Microsoft is the next company in my portfolio, and I own 0.8 shares in this company, valued at £165. I'm currently up around 25% in this investment, which equates to around £32.50. Companies all across the world use Microsoft, so this is a company again I'm going to continue to invest in. And the silver lining is they also pay a 1.04% dividend, which gives me potential income into my portfolio alongside any capital growth that I'll see from this company. The new kid on the block is of course Pfizer. This is a company again that I've invested into fairly recently, and I do see this as a strong company for the future. They are one of the front-running vaccine creators, and they're also now looking at potential booster vaccinations every single year. Now this all means more money for Pfizer, more income and more exposure internationally, which I believe will push up the share price. I currently own 5.9 shares in Pfizer valued at £191, and I'm currently up around 10%, and I've only been invested in them for around 6 weeks now. And this equates to an £18 return on investment. A little side note, the vaccination I had was also Pfizer, so I've got a little bit more of a buy into this company than perhaps I would have done otherwise. Realty Income is the next company on my portfolio which offers a 4.22% dividend, and this is essentially my exposure to property both in America and in the United Kingdom, mostly from a commercial basis. Realty Income pays its dividend monthly, which gives my portfolio much needed income every single month. So I will be extending my position within Realty Income to hopefully increase that income into my portfolio to mean that I can then reinvest that and then reap the rewards of more dividends in the future. Next is Royal Dutch Shell, and as you can see, the share price still hasn't recovered from its pre-lockdown highs of around £22 or £23 per share. It currently trades at around £14.50. I currently own 10.5 shares in this company, and I'm up a little over 20%, or £25.84. My current total invested amount is £152.47. Now, investing in companies like this, especially in oil, is a bit of a contrarian thing to do. We all know that oil and fossil fuel use is phasing out, and there's lots of people who are pushing it very hard now to move towards largely clean energy, and this is something that I really believe in as well. So I'm going to be keeping a really close eye on Royal Dutch Shell, looking at their future plans and their future proposals and how they see themselves moving from their fossil fuel energy production to more clean energy production in the future. If I see that as a positive and it aligns with my own beliefs and it aligns with what I think is going to be making money in the future, I will continue to invest into this company. However, if they are going to be stuck in their ways and stick towards just fossil fuels and not develop new ways to create energy and move into the 21st century, then I will of course at some point be selling out of this position. We've then got the coffee connoisseurs, Starbucks, which have had an amazing year all things considered. Lockdowns should have really impacted them, with shops closing up and nobody going out for coffee. But as you can see on the table here, since that initial hit after lockdown, they've gone from strength to strength. And year to date, they're up almost 60%. They've also added almost 35% to their share price since its initial high before the lockdowns occurred, which is excellent for this company. I currently own 1.65 shares in the company, valued at £140.23. I'm up a little over 11% in Starbucks, and I'm just going to sit and hold these for now. I'm not going to be buying any more, just going to sit and hold and take that small dividend income that they pay quarterly. Tesla is the next company in my portfolio, and I've got a very large weighting towards this company. This is more out of the growth that Tesla has seen rather than my continual investments into the company. I currently own just over 1 share in Tesla, valued at £511.23, and I've seen a return on investment of around 40%, or £144.70. Tesla is a really volatile stock. However, I really believe in this company. I've seen lots of videos on YouTube about people saying that this stock and share price could continue to increase with the potential revenue and the potential sales that they'll be making in the future. Tesla is no longer just a car manufacturer. It's doing a lot for the development of clean energy, for battery enhancements and other technological enhancements within that space, which is of course an expanding industry. For this reason, I'm going to continue to hold this Tesla stock. I may, if there's a dip, buy in a little bit more, but you can see this has been growing again fairly steadily over the last month or so. We've then got Unilever. I currently own 4 shares in Unilever, valued at £164.82, and I'm up around 2.5%. I was actually up around almost 10 to 15% within this company before this nice little drop that you can see here on screen. And this was to do with the news that the raw materials for Unilever products were increasing in value, which meant that their profit margin actually reduced. So this is the reason for that large decline here in share price. This is a problem across a number of different sectors at the moment, especially within the construction industry. We all know that the cost of wood and construction products are massively increasing at the moment, and what this means is that the cost of things are increasing and the potential profit margins are also decreasing. And this is probably something that we can come to expect within the next year to 18 months, potentially longer. So don't be surprised if this happens to other companies within this similar industry. The final company in my portfolio is Walt Disney. I currently own 1.1 shares in the company, and that's valued at £137. My investment here is up just under 1%, and they have also obviously cut their dividend in the past year or so. So this is a company that I've left alone, I'll be completely honest. I've not touched it for quite a long period of time now. And this is another company that I am thinking quite seriously about selling out of and moving towards a dividend paying company, because at the end of the day, £140, if I can find a company that pays a 2% dividend, that would give me around £3 per year. And that might not sound like a lot, but that is growth, that is income that I can then reinvest and grow this portfolio at a greater rate than Walt Disney is at the moment, because it has stagnated somewhat of late. We can also hop in and have a look at my recent dividend income. You can see I've made £2.22 from AT&T, 58 pence from Realty Income, but remember that is a monthly dividend, so I make that or more every single month. 91 pence from Coca-Cola, £1.29 from Royal Dutch Shell, £1.11 from Unilever, and if we scroll down a little further, you can see my biggest dividend payment to date of £4 from BAE Systems. All of this collated then equates to a total dividend earnings of £32.55. And when we take into consideration that large proportions of my portfolio at the moment, despite this intending to be a dividend portfolio, are in companies like Tesla and Alphabet, which don't yet pay a dividend, or obviously Amazon as well, I'm really pleased with that £32.55, and that's literally just for having my money in this portfolio. Before we finish, I just want to praise Trading212 for their new desktop app. This is a much cleaner version of the old desktop app that they used to have. Everything is intuitive and in a clear and logical place. You don't need to look around the screen now to work out what you're trying to look for. If we flick back across to the old desktop app, here, it's a much more busy place to be, and I far prefer the newer iteration of the app. I find it much more intuitive and it just makes more sense to me. It's actually a lot closer to the mobile app than it used to be as well. So really well done to Trading212, and hopefully we'll see them taking on new customers very, very soon. So there we have it guys, my Trading212 portfolio. I hope you've enjoyed the update, and thank you very much for watching. If you do want to sign up to Trading212 or a different investment platform such as Freetrade, I've got links down in the description below which will give you a free share when you invest just £1 on Trading212 or £2 on Freetrade. And this will help to get your investments kick-started and get you off and running. One of the ways that I've managed to invest so much money into both my Vanguard account, eToro and Trading212 is by developing different streams of income, one of which is matched betting, and this has made me over £7,000 in income now from just using bookmaker offers against them essentially. If that sounds like something you'd be interested in, making a few £100s every single month completely tax and risk free, again check out the link up above. I'll pop a link up there to take you to one of my videos explaining exactly what match betting is. And again, there's a link down in the description below towards the software that I use to do match betting, which is called Profit Accumulator. It does charge £24.99 now for its match betting software. However, that is more than worth it. I've had months where I've made over £1,000 from match betting, or more consistently around £400 to £500. If that extra income would be useful to you, please do check that link down below and start your own match betting journey. With that said though, thank you very much for watching. If you have enjoyed it, please do like and comment on the video. I'll go through all the comments and try to get back to as many as possible. And if you haven't yet subscribed to the channel, please also consider doing that as well, to help to push videos like this out to a wider audience and to help to grow the community that we've got growing on this channel. With that said though guys, I will catch you all very soon in the next one.